There's a 3% chance that Jesus Christ will return to Earth before 2027 on Polymarket. That means that if you bet just $100 on it at the time of writing, and Jesus actually returns this year, you would win over $3,000. But what if you bet that Jesus won't return? Well, if you win, then you get a profit of $3 for the 100 that you put in. Sounds like free money, right? Well, the crazy thing is, it actually was. In April 2025, betting against Jesus actually outperformed U.S. Treasury bills. But the Jesus bet isn't even close to the weirdest thing happening on these platforms. In summer 2025, people placed over $240 million of bets on whether Ukrainian President Zelenskyy would wear a suit before July. He showed up to a NATO summit wearing a black jacket, dress pants, and trainers. The BBC, the New York Times, and Reuters called it a suit. Even Zelenskyy himself referred to it as his suit. But the people who bet on Zelenskyy wearing a suit lost. Why? The people who actually decide whether bettors win or lose aren't journalists or fashion experts. They're a small group of huge cryptocurrency whales who vote on truth. And 98% of them voted that it wasn't a suit. Someone lost $300,000 because Zelenskyy wore the wrong shoes. But recently, things have been getting a bit more unsettling. In early January 2026, there was a bet on whether Venezuelan President Nicolas Maduro would be captured within the month. It seemed outrageous at the time. The market gave this about 5% odds. But there was one guy who placed a crazy $32,000 bet that he would be captured. Just 5 hours later, 150 American aircraft bombed Caracas. By the next morning, Maduro was in U.S. custody. That $32,000 bet paid out over $400,000 to this anonymous bettor, and the platform honored it. No questions asked. The account was less than a week old. It only ever bet on events related to Venezuela. One tracking firm called it a clear case of insider trading. Someone apparently had advanced knowledge of a classified military operation, one that killed at least 80 people, and used it to make $500,000. Now compare that to this guy, a man called Yuri Andrade. Back in 2021, Yuri bet $50,000 that someone would run onto the field during the Super Bowl. Then he put on a pink thong and did exactly that. The sportsbook voided every single bet connected to him. They called it manipulation and refused to pay the winners. Something doesn't add up here. Why does the guy in the pink thong get nothing, while the person who apparently knew about a secret military attack gets fully paid? Today on the Capital Desk, we'll show you how prediction markets might actually work by selling your predictions to powerful institutions. And at the end, we'll show you why almost anyone can still bet on Jesus' second coming on Polymarket, while sports betting triggers crackdowns everywhere. Make sure to stick around for that.
Welcome to the Capital Desk, where we cover the structure behind the stories.
To answer all of the tough questions, we need to understand how a prediction market like Kalshi or Polymarket works. The basic mechanics are actually pretty simple. A prediction market works like a stock exchange, except instead of buying shares in companies, you're buying shares in outcomes. Think of it like this. There's a market on whether it'll rain in London tomorrow. You can buy a yes share or a no share. If it rains, yes pays out $1. If it doesn't, no pays $1. The clever bit is the price. If yes shares are trading at 70 cents, that essentially means that everyone believes there's a 70% chance of rain. The price becomes a probability estimate, one that's constantly updating based on what everyone's willing to pay. Unlike a sports betting platform which sets odds based on their own models, prediction market prices emerge from thousands of people putting real money behind what they believe. Money talks. At least, that's the theory. For years, the general public barely knew these markets existed. Then came the November 2024 U.S. election. In the weeks leading up to Election Day, most polls showed Kamala Harris and Donald Trump in a deadlock. Nobody knew who would win. But if you looked at Polymarket, you saw something different. From around October 18th, their data showed Trump as the clear favorite. The market had made up its mind while everyone was still scratching their heads. And they were right. That single event transformed these platforms from curiosity to phenomenon almost overnight. Kalshi processed $23.8 billion in trades during 2025, 11 times more than the year before. At the time of writing in January 2026, they are running at an annualized rate exceeding $100 billion. The company itself is now valued at approximately $11 billion. Lopez Lara, who co-founded Kalshi in her 20s, recently became the youngest self-made female billionaire in history. Robinhood, the retail stock trading app, launched prediction markets and called them their fastest-growing product by revenue ever. Even Trump Media got in on it. In October 2025, they announced Truth Predict, a prediction market built right into Truth Social, which creates a ridiculous situation where a current president's company might profit from people betting on policies he controls. Even the parent company of the New York Stock Exchange invested $2 billion into Polymarket. So on the surface, this looks like genuine financial innovation. But there's a question nobody seems to want to answer directly.
How do these platforms actually make money? This seems like it should be straightforward. Trading platforms make money from fees. That's the model. Always has been. But the fee structures here are strange. Kalshi charges about 1.2% on trades. Polymarket charges almost nothing. For years, they charged 0 trading fees, but recently they raised it to 0.01%, literally 100 times less than Kalshi, for when they launch in the US. So how do companies charging nothing attract billions in investment? The honest answer is, we don't fully know. Neither company has published detailed revenue breakdowns, but multiple analysts and industry observers have converged on the same theory. Prediction markets are planning to charge institutions lots of money to get access to the live data. Think about what these platforms have created. Real-time probability estimates on thousands of world events, elections, geopolitical conflicts, celebrity behavior, military operations. For a hedge fund or bank trying to model risk, that data is potentially worth a fortune. There's already evidence institutions are paying attention. Goldman Sachs has reportedly used Polymarket pricing as an input for their models, specifically to estimate things like the probability of Iran closing the Strait of Hormuz and the knock-on effects for oil prices. If you're managing billions of dollars and you can get a better read on geopolitical risk, you'll pay handsomely for it. Which brings us to something that sounds completely backwards at first, but actually explains a lot of what's happening. Hey there! If you're finding this video useful, consider liking, subscribing, and share your thoughts in the comments. With your support, we can do videos like this regularly. Thanks for your support. And now, back to the video. Now, so far, we understand that prediction markets might be trying to make money by selling accurate data to institutions. Remember the crazy bet on Maduro? An anonymous person bet $32,000 on a 5% probability event. 5 hours later, 150 aircraft proved them right. If that person had inside knowledge of the military operation, which the evidence strongly suggests, then their bet immediately made the market price more accurate. The moment they clicked buy, the probability estimate shifted closer to reality. For a company selling predictive data, that's valuable. In traditional financial markets like the stock market, insider trading breaks the market. That's why it's illegal. Inside traders are extracting value from people who don't have access to the same information. But prediction markets don't work the same way. Insider trading simply makes the market's predictions more likely to come true, meaning that the platform can sell it for a higher price. It simply makes financial sense for Kalshi and Polymarket to encourage insider trading. I'm not saying the platforms endorse this. I'm not even saying they consciously think about it this way. But the incentive structure is what it is, and enforcement is difficult. It's such a new legal gray area that nobody really knows how to deal with it yet. The CFTC, the federal agency that regulates these markets,
even had a former enforcement attorney tell Politico that agency is simply not equipped to police insider trading at scale. Now, to be fair, the platforms do claim to prevent this kind of thing. Kalshi publicly states they screen for politically exposed persons. And sometimes they do enforce. Remember Yuri Andrade, the Super Bowl streaker? When sportsbooks realized he'd bet on himself running onto the field, they voided every connected wager, called it manipulation. But here's the crucial difference. A streaker manipulating his own prop bet doesn't make the market more accurate. It makes it less useful. A streaker's bet is pure noise, manufactured certainty that tells you nothing about the world. An insider betting on a military operation, though, that's a signal. The same anonymous Maduro bettor actually made money. Twice. On the day they bet on Maduro's capture, they also bought $1,000 worth of contracts predicting the U.S. would invade Venezuela. They got those at 6 cents each. When the bombing happened, the price spiked to 18 cents and they sold, for a 200% profit, before anyone even decided whether it technically counted as an invasion. Eventually, the platform ruled it wasn't an invasion. The price crashed back to 5 cents. But that trader was already gone. So let's answer the question. Why can you bet on Jesus returning to Earth, on classified military operations, on a president's clothes, but sports betting and casinos get banned everywhere you look? The answer comes down to a two-word phrase: price discovery. This is how prediction markets escaped gambling regulation. In 2020, Kalshi applied to the regulators, the CFTC, and made an unusual argument. They said, "Hey, we aren't operating a casino. We're enabling price discovery." Price discovery is what happens when buyers and sellers interact to establish the value of something. It's what stock markets do for company shares, what commodity markets do for oil and wheat. Kalshi argued their contracts do the same thing, except instead of discovering the price of assets, they discover the probability of events. And the CFTC said, "Okay, sounds good." They approved Kalshi as a designated contract market, which is federally regulated. For context, gambling regulation is mostly state jurisdiction, and there are all sorts of rules in place to protect people who gamble. By becoming a federally regulated financial exchange, Kalshi could theoretically operate across all 50 states without needing permission from each state's gaming commission. That's why you can bet on Jesus. Will Jesus return isn't a sports gamble. Under the CFTC's logic, it's a probability estimate about a future occurrence. Same with Zelensky's suit. Same with Maduro's capture. But the ironic thing is, sports has become these platforms' biggest moneymaker. In November 2025, a staggering 91% of Kalshi's $5.8 billion monthly volume came from sports contracts. Sports is what's actually generating revenue. Right now, it seems like regulators might be slowly catching on. Since November 2025, at least 11 states have issued cease and desist orders. But for now, in most places, Jesus isn't covered by existing gambling law. You can bet on all of those crazy things because sports betting regulation hasn't caught up yet. So let's bring this full circle. You can bet on Jesus returning to Earth because regulators haven't figured out how to regulate it yet. And the platforms may actually benefit when insiders make predictions more accurate because the enforcement capacity to stop it doesn't exist. The financial incentive to prevent it is debatable at best. Prediction markets found a legal gray zone and built a $100 billion industry inside it. They correctly called an election the experts got wrong. They've attracted investment from the people who own the New York Stock Exchange. CNN puts their odds on television like their stock prices. Although none of that means that they're immune to manipulation, or that their core product, accurate probabilities, is as reliable as they claim. But still, these markets are almost certainly here to stay. The momentum is too strong, the investment too deep. And as they scale, as prediction market odds become as common as stock tickers on your evening news, it's worth remembering what we're actually building. A system where being right matters less than knowing something others don't. Where the line between investing and gambling is a legal technicality. Where someone can profit from a military operation that killed 80 people, and the platform calls it price discovery. Is all of this just gambling with better marketing? Or is that really innovation? Personally, I'd place the odds at around 3%. Thank you for joining us on the Capital Desk. Let us know what you think in the comments. If you enjoyed this video, drop us a like and subscribe for more videos explaining the structure behind the stories.